So let's continue with the rules of a valid order block. The first rule is having inefficiency. Inefficiency, imbalance, and fair value gaps are highly similar concepts. When a large amount of money enters the market and creates an imbalance between the buyers and sellers, the fair value gap patterns form between the candles, creating a phase of inefficiency. These movements on the chart show that smart money has entered the market and affected the price. Price often returns to these areas to accumulate the remaining orders, which creates a trading opportunity. The price takes off after reaching order blocks, but only if there exist remaining orders. So, a supply or demand area that created the fair value gaps becomes a strong level. We always mark the fair value gaps on the chart when mapping the market structure, which is the first rule of identifying a valid order block. The second rule for having a valid order block is breaking the market structure. In the bullish scenario, when a price movement breaks the latest market structure and closes above the recent high, the origin of the price movement becomes highly important. It shows that the demand area that created this movement is not an ordinary level, but an influential area in the market structure. With all being said, a supply or demand zone is considered a valid order block that leads to a structural break. The same concept is applied to the bearish scenario. When a price movement breaks the latest market structure to the downside, the origin of the price movement becomes highly important. It shows that the supply area that created this movement is not an ordinary level, but an influential zone in the market structure. So these demand areas are considered valid order blocks. Here we have a moving uptrend. This is the most recent break of structure, which shows that the demand is still in control. All these demand areas are considered an opportunity to go short. But here is an important point. The origin of this bullish price movement is highly important and provides the best trading opportunities. There is a high chance that the rest become a victim of liquidity grab. That's why we have to use a lower risk when placing trades in these areas. If you have any doubts about identifying a valid break of structure or reversal, make sure to watch our previous videos about market structure concepts, which are linked in the description. Let's move on to the next rule. But before we continue, if you're curious about how we stay updated on combining the liquidity concept with order blocks enhances our understanding of market dynamics and provides valuable information for strategic decision-making. Grabbing liquidity in the direction of the current trend before reaching a supply and demand area improves the quality of that area. There are 3 common liquidity grab patterns that happen every day on the chart. Forming each one before reaching our order block increases the chance of success for our trade. Let's start with the first one. The first liquidity grab pattern is when we have fair value gaps and an order block zone precisely below our demand area. So, there is a high chance that the first demand area becomes the victim of a liquidity grab movement, and then the price takes off when it reaches our order block zone. This will make our order block zone even more powerful, because right now, the market contains the required liquidity for future movements. For example, here we have a demand area and a potential trading opportunity to go long. But looking at the left side, we can spot this gap between the candles, precisely below the demand zone. Now this gap will act as a magnet for the price to come and fill it, restore the balance, grab the liquidity, and continue pushing upwards when it mitigates the order block. So here comes an important point. Before placing any trade, you should look at the left side to see the market structure conditions to avoid this kind of unnecessary risk. So, when this kind of scenario forms on the chart, there's a higher chance for this move to be just a liquidity grab and does not necessarily mean a reversal is coming, making our order block zone more powerful and a perfect trading opportunity to go long. The second liquidity grab pattern happens by forming equal highs and lows. Equal highs and lows are interesting trading areas for traditional support and resistance traders. In the bullish scenario, below the equal lows contain lots of liquidity. If the correction move consists of this kind of support area, this is another confirmation that the conditions are ready for smart money to grab the liquidity and continue pushing forward when the price reaches the demand zone. The same concept is applied to the bearish scenario. Above the equal highs contain lots of liquidity. If the correction move consists of this kind of resistance area, this is another confirmation that the conditions are ready for smart money to grab the liquidity and continue pushing downwards when the price reaches the supply zone. Defining precise rules for every scenario that happens on the chart is tough. Yet, as you engage in backtesting and live trading, the key lies in adjusting your trading system to align with the optimal conditions that work most effectively for you. Backtesting is necessary to obtain the performance of a trading setup, but unfortunately, it can take a lot of time. That is why we use Trader Edge.